Hi everybody, again foreign currency transactions. We will continue the discussion of the last learning objective of this chapter, accounting treatment given various types of foreign currency hedge. We will move to discuss example of fair value hedge. Let us see this one to how we will recognize the amount of foreign currency liability and how we will hedge ourselves against the fluctuation of exchange rate risk. Here our company purchases, or the company purchases, Ruby company purchases equipment costing 200,000 yen, the currency of Japan, on 2nd December 2016 with payment due on 30 January 2017. After 2 months, we will settle the amount we owe as we purchase the equipment by 200,000 yen. We will settle this amount on 30 January 2017. On the same day of purchasing this equipment, the company enters a forward contract to purchase 200,000 yen on 30 January, the settlement date or the payment due date, at the forward contract rate of 0.0095. Let us see how we will recognize and record this transaction as we have the foreign currency exchange rate on these different days. On the date of purchase the equipment, the spot rate were 0.0094. As we owe by 200,000 yen, so the amount that we have to record it by the US dollar equal 200,000 yen multiplied by the exchange rate on the date of transaction, which is 0.0094. So the amount that we owe by US dollar is 1,880. Be careful. When we record the transaction, we have to record the transaction by the reporting currency or by the functional currency. Functional currency means that the currency that we use to record our financial transaction or to prepare our financial report. Here, the transaction that we owe will be recorded by 1,880 on the date of this transaction, on the 2nd of December. On the other hand, as we entered into forward contract, also we will record the forward contract that we entered to. Here, we entered into forward contract to purchase the 200,000 that we owe by 0.0095. It means we will pay 1,900. So in this case, as we entered into forward contract to settle the amount we owe on 30 January 2017, here in this transaction, we owe by 1,900 as we entered into forward contract. On the other hand, we will receive 200,000 yen. Be careful. We entered into this forward contract to pay fixed amount, which is 1,900. It means we have payable by 1,900. On the other hand, we have receivable, because as we will pay this amount 1,900 as we owe, on the other hand, we have receivable. The counterparty will pay to us 200,000 yen. So as we have forward contract, we have two parties. One of them is forward contract receivable. On the other hand, we have forward contract payable. We will receive 200,000 yen from the receivables, from the counterparty, and we will pay them 1,900. So let us see how we will record the transaction on 2nd December. Let us move to C. As we purchase equipment by This is the amount. Already we have translated it, 200,000 by 0094. So we will debit the amount of equipment by 1,880 and accounts payable, the amount we owe as we purchase equipment is 1,880. On the other hand, you have to record the transaction of entering into forward contract. Again, as we entered into forward contract, we will receive we will pay fixed amount by 1,900 to receive 200,000 yen. So we owe by 1,900 as fixed amount we have to pay it. So contract payable will be debited by 1,900. On the other hand, we will receive 200,000 yen. This amount, which is 200,000 yen on the date of recording the transaction, equal 1,900. So contract receivable is debited by 1,900. Be careful here. This amount that we will receive on the date of settlement will be exposed to the fluctuation of exchange rate. We will receive 200,000 yen. On the date of the preparing the financial statement, you have to adjust this amount, contract receivable, to the fluctuation of exchange rate. On the settlement date, also you have to adjust it, because contract receivable, the 200,000 yen that we will receive, it will be exposed to the fluctuation of exchange rate. But the contracts payable is fixed because we will pay fixed amount. So here the point is, against the fluctuation of accounts payable that we are going to pay, on the other hand, we have a fluctuated amount that is contract receivable. But the contracts payable will be fixed. Let us move to the date of preparing the financial statement to see what we will do on the date of preparing the financial statement. Let us see here. On the date of preparing the financial statement, the exchange rate has been declined from 94 to 92. Let us see how we will recognize the amount of gain or loss. Here, I owe by 1,880. But this amount I owe, the value of it has been declined to 1,840. Suppose I'm going to pay the amount I owe on the date of preparing the financial statement. I will pay 200,000 yen. As I will buy it and to settle it, so I will buy this amount, the 200,000 which I owe, I will buy it by 1,840. So in this case, we have gain. As the amount I owe has been declined, I will settle 200,000. It's fixed, 200,000 yen. He will receive 200,000. But the point is, as I recorded on the date of recognizing the transaction by 1,800, but the value of it has been declined because of declining the spot rate from 94 to 92. So the amount I owe is fixed, is 200,000 yen, but I will buy it by 1,840, so I have gain in this case. On the other hand, we have agreement. We have entered into forward contract to buy the 200,000 yen by 1,900. So I will pay this fixed amount, 1,900, whatever is occurred. But the prices of the forward contract has been declined from 92 to 93. So in this case, as I will pay fixed amount 1,900 and I will receive 200,000 yen, this amount that I will receive it, the value of it has been declined from 1,900 to 1,860. So in this case, against the contract receivable, as I will receive 200,000, the value of 200,000 that I will receive it is declined. So in this case, I have loss. Okay, let us see how we will record it. First of all, we will record this transaction. The amount I owe has been declined from 1,880 to 1,840. So it means I have gain. Accounts payable will be debited. The amount I owe will be declined by 40. The difference between 880 and 840 is $40. On the other hand, I have exchange gain by $40. On the other hand, as the amount that I will receive is declined from 1,009 to 1,860, also here we have loss by $40 because the amount that I will pay is fixed. Okay, doesn't matter. But the amount that I will receive is $200,000. I recorded it as I own it as receivable by 1,900. But the value of this receivable, because of declining the forward rate from 95 to 93 has been declined, so we have loss. So how we will record it? Exchange loss. We have to adjust foreign monetary accounts to current. Exchange loss 40, and the contract receivable, this is the accounts receivable. To simplify it, the value of accounts receivable or contract receivable declined from 1,900 to 1,860. Okay, let us continue to see what happened on 30 January, the settlement date. Here, the amount we owe already adjusted to be 1,840 on the date of preparing the financial statement. But on the settlement date, the spot rate, the exchange rate, has been increased from 92 to 98. So it means that when we will buy the 200,000 yen, the exchange rate has been increased. Increasing the exchange rate when we will buy the foreign currency, it means that we have occurred loss. So here the value of loss equals the difference between the adjusted amount on the date of preparing the financial statement and the amount that we have to settle on the settlement date, which is 1,960. So here we have loss by the difference between 1,840 and 1,960. So here we are talking about 120. Let us move to see what's the result of entering into forward contract. As we own contract receivable adjusted to be 1,860 on the date of preparing the financial statement, it means that we will receive 200,000 yen. We evaluated it on the date of preparing the financial statement by 1,860. Here, when we move to settlement date 30 January, the value of the 200,000 yen that we will receive it on this date increased to be 1,960. So it means that we have gain as the value of receivables increased from 1,860 to 1,960. It means we have gained by $100. Let us see how we will record it on January 30. We will settle the forward contract. It means we will pay them the 1,900, the amount we owe, to receive 200,000 yen. Okay. First of all, we will pay them, and then they will pay us. We will pay them the amount we owe, contract payable, here already recorded by 1,900 on the date of entering into forward contract. We will pay them fixed amount. This is the benefit of entering into forward contract. We will pay them 1,900. So contract payable will be debited by 1,900. So we don't have any amount. We don't have all amount as we settle this transaction, and we will pay 1,900. Here, against the amount that we paid, we will receive. What we will receive? We will receive 200,000 yen. The amount that we receive it, 200,000 yen, on the date of settlement equal 200,000 yen multiplied by 98 equal 1,960. So we record it cash debited, cash in yen debited that we received 200,000, but the value of this amount on the settlement date 1,960. We received this amount against what? Against the contract receivable. Contract receivable balance on the settlement date equal, look, it's debited by 1,900 and credited by 40. So the amount we own is 1,860. Debited by 1,900, credited by 40. So we are talking about debited amount 1,860. But against this amount that we own, we received 1,960. Why? Because the exchange rate has been increased from 93 to 98. So we have receivable, and the value of this receivable has been increased because of increasing the exchange rate. So we have gain. How we will record it? The difference is $100 because we settled it on the date of preparing the financial statement by 1,860. On the date of settlement, we will receive 200,000 yen, but the value of this amount we received is 1,960, and the amount we own is 1,860. So we have $100 as exchange gain. Okay. Right now we have received $200,000 to settle the forward contract. These two entries to settle the forward contract. We pay the fixed amount we owe 1,900 and we receive the 200,000 that equal 1,960. At the end, we have to settle the amount of accounts payable. At the beginning, we entered into this forward contract to protect ourselves against the fluctuation of accounts payable. Here, the accounts payable balance, as you remember, is 1,840. 1,840 already settled on the date of preparing the financial statement. But right now, we will pay them 200,000 yen. The value of this amount that we are going to pay them, as we received it a minute ago here, is 1,960. We will pay them 200,000, but the value of this amount is 1,960, and they owe us only by 1,840. We will not pay them US dollar. We will pay them 200,000 yen. The value of this amount we owe is 1,960, but the amount, the accounts payable balance is 1,840. As we will pay them 200,060, which equal 1,960, and they owe us only 1,840, it means that we have exchange loss, so we have to record it. We have exchange loss by $120. So now the question is, what's the result of this hedge, of this fair value hedge? Is it sufficient or not? Let us move back to see the differences. Here on the date of preparing the financial statement and on the date of settlement, we have gained by 40 and lost by 120. So here we are talking about, because of the fluctuation of accounts payable, we are talking about loss by $80. On the other hand, as we entered into forward contract, we have lost by 40 and gained by 100. So we are talking about gain by 60. Gain by 60 and loss by 20. So the result is net loss for January is $20. This is the result of entering into the forward contract. On the other hand, suppose we didn't enter into forward contract, so we will get loss, net loss by 80, the difference between 40 and 120. If we didn't enter forward contract, we will occur loss by $80. So we can say we have entered into sufficient contract as the loss has been declined from 80 to 20. I think until now it's enough. Let us move to the coming video. We will discuss additional example to clarify how we or what's the accounting treatment of cash flow hedge.